What is going on, everybody? Welcome to your Hyperclass or Hyperchat webinar. My name is Q. I am the founder and leader of Hyperstocks. I really wanted to record this webinar because I wanted to deliver a clear-cut message to all the members who are in our group because I think it's important. As the stock market has developed over the last few years, I believe that the image and the view towards it has been diluted to be more than it actually is. So the stock market is a money-making machine for a lot of people. And if you approach it with the right mentality, then you're going to be successful. It may take some trial and error. It may take some changes on your end, but I want to let you know that as long as you follow the rules, you will be fine. And I also want to let you know that there are hundreds and hundreds of strategies that have been created by different mentors out there. Some of them may be successful, some of them maybe not. But the idea here is if you're going to be a part of a group and a part of a community, you need to have the same vision as the leader and as the community has. And I hope to deliver that vision for you today. That way you understand what kind of community you're in and what kind of approach that we have for the stock market. In this webinar, I'm also going to talk about the different strategies that we have. And the great thing about Hyperstocks is that our strategies fit different lifestyles. So from the different information that I give you today, I hope you derive which strategy fits your lifestyle the best and you're able to stick to it. Let's go ahead and get started. First of all, let's talk about stock market psychology. So approaching the stock market with the right mentality is going to be key. So I can teach you all types of charts. I can teach you all types of technical analysis. The foundation of all your trading is going to be with the mentality you bring to the stock market. Me personally, I've always approached the stock market in a modest way, which means I take profits when I could and I cut losses when I can as well. I'm not coming into the stock market every day hoping to make $1 million. I come into the stock market every day to make enough money to pay my bills and to feed myself, my cat, whatever it is that I'm trying to do. Don't come into the stock market with the gambler ideology that we're going to be spending a ton of money on a specific stock just to try to make as much money as we can. That is not what we do. That is not a sustainable way to approach the stock market. There is a big difference between gambling and trading. Trading has defined risks. Gambling does not. So, with that being said, let's move on to the next bullet point here, and that's creating a blueprint for every setup. Everything you see that's successful in front of you, whether it's a company, whether it's a career, whether it's a building on the ground, has had a blueprint before it successfully was built. And that's how you need to approach every single setup on the stock market. If you're entering a setup without an exit point or a defined loss point, stop loss point, then you're already approaching the stock market in the wrong way. There's nothing wrong with not knowing how to create this blueprint because that's what you have me and the community for. And we're going to talk a little bit more about setups as we move on through the slides. Second, trading is a ratios career. So if you're new to the market, you may not know this. And if you're experienced, sometimes you still don't know this. And I see this happen all the time with traders. You're not going to win every single trade. And you're also not going to be profitable every single day. Unfortunately, I have to break that news to you, but it's just the way it works, and that's why we have a stop loss in every single setup we take on. A lot of traders will purchase a stock and not know when to exit because they simply do not want to take a loss on their position. However, when it comes to day trading and swing trading, losses are a part of the game. The idea is to have more income than outcome. So that's all it is. As long as the outcome is income and as long as 3 out of your 5 trade setups hit, then you're already winning. You cannot win every single setup, which is why I always tell people to measure your success by weekly, monthly, yearly percentages. Don't measure your day-to-day success because you're going to drive yourself crazy on those losing days. You have to understand that losses are a part of trading, but the idea is to limit losses, which is why if you've been in our community, you know that our losses are usually a lot less in risk than our profit potential on a setup. Meaning if we enter a stock at 5, our stop loss is typically at $4.50, while our upside potential is $7. So we still walk away a lot more profitable and cut losses at a lot less percentage than the upside potential. More on this later. 3, Pay yourself. Make sure you're paying yourself from your profits, or else you're not going to understand the value of the money in your account. So, yes, the idea is to grow your account, but you need to pay yourself out of that account to understand how much money is coming in and out, and it helps you gauge your success. If you can't pay yourself, you're doing something wrong. You're not making enough money. If you have a very, very small account, I understand why you'd want to grow it, but you want to get to a point in which you're able to take out monthly or weekly profits to pay yourself, to pay your bills, to have nice dinners, whatever it is. Look at trading as a source of income. Don't look at it as a gambler would look at a poker table, because gamblers will play and gamble until they lose all their money. Don't do that to yourself in the stock market. That's not the approach here. We are trading. We're treating trading as a career here, and even if it's a part-time job for you, even if it's a side hustle, it's still important to pay yourself. Using proper position sizing, we're going to talk more about this later. So, what are the different types of trading strategies that Hyperstocks brings to the table? First, we have scalp or day trading. This is the shortest form of a trade, and you would want to use a cash account to do this to avoid the PDT rule. More on this on the next slide. Swing trading. This is a 2 to 5 day hold, sometimes more. Sometimes we have to exit a swing trade the same day because of unexpected downturn in the market. Position trades could be weeks to months. So, first, let's talk about day trading and scalping. What is defined as a day trade? A day trade is the purchase and sale of a stock within the same day. This could be seconds, this could be hours, this could be moments. As long as it's bought and sold the same day, it's defined as a day trade. What is the difference between scalping and day trading? They're really the same thing, but if you see the word scalp trade, it typically means it's a higher risk company that is not really worth an investment. It's not valuable enough for it to be defined as a company in which you can safely hold overnight. Which is why I tell you, you have to read every setup that I send. If I specify that it's a day trade or a scalp trade, you cannot risk holding this overnight, because you are risking oblivion. You're not really risking something in which is like an apple. Apple, yes, if you bought today and it went down, you can hold for as long as you want for it to come back around. But if you're buying a random penny stock in which we're just scalping for the day, you cannot risk holding it overnight, because those stocks at times will fall and they won't come back around for months or years, even if they ever even come back around. So very important to follow the rules when it comes to these setups. Now let's talk about the PDT rule, or the pattern day trading rule. So this rule is not something that's limited to Robinhood. It's not something limited to any trading platform. This is a actual rule created by the Security and Exchange Commissions to protect traders in margin accounts from overtrading and losing too much money. This could be avoided by simply creating a cash account. So if you go to Webull or Thinkorswim by TD Ameritrade, you can open up what is called an individual cash account, and this will eliminate the pattern day trading rule from your life. And if I always tell people, it sucks with the cash account. I know that you have to wait for your funds to settle. So rather than having the money that so say you sold a stock at $1,000, you won't be able to use that money for 2 to 3 days until the cash settles. But I always tell people, this teaches you to have a better position sizing. So if you have a $10,000 account and you know that if you use that $10,000, you won't be able to use it for 3 days, this is even better for you, because now it limits you to creating 10 different trades. So rather than using 10,000 for one trade, use 1,000 per trade, and now you have 10 different opportunities to make money, and your ratios are better odds for you to walk away profitable. Approaching day trades and scalps. So anticipate a very quick trade at times, sometimes only a few percentage move. What fits a day trading and scalping strategy? So who is supposed to take these trades on? I would suggest that if you are not the person who is available to be in front of your computer and is very on point and is constantly checking the market, if you can't afford to be watching the stock through the day while you're in the position, then you cannot afford to be in these trades. These are meant for people who are constantly in front of their computers and are constantly monitoring the stock market. So if you are a full-time employee, don't worry about this too much. You want to focus more on the swing trades and the position trades for you to succeed on the stock market, because sometimes these day trades move so quick that if you missed 5 seconds or 10 seconds from the exit, you are already down from the position's highs. So you don't want to be, throwing money in something and not being able to check it right away for updates or exit profits, or exit updates or alerts. So what are we looking for when it comes to day trades and scalp trades? First thing we're looking at is high volume stocks. So we want stocks with a lot of volume. That way liquidity is easy. There's a lot of people coming in and out of the stock and they're moving it in the right direction. Number two, catalyst. So we want to find stocks that have some kind of catalyst for the day. A lot of times that we trade stocks on scalp trades or day trades, there is a small catalyst that's driving a random penny stock out there temporarily, and we're taking full advantage of the day's movements. Number three, short squeeze. So short squeeze is another big strategy that has come up in 2021, but short squeezes have been around ever since shorting the market has been around. It's just gotten more and more attention in 2021 because of the GameStop and the Wall Street bets frenzy. Number four, momentum. Momentum is not something you can measure. This is something you can only see and feel. It's like an instinct that you have for the market after years and years of looking at charts. We know when there's a strong momentum day and we take full advantage of it. Something to also mention about momentum is I always like to think that the stock market is like the tax season for accountants. Though that specific tax season, they're going to make a lot of money, and then they're going to be surviving here and there through the year, making slow money. So sometimes the market will catch a full-on momentum swing, and it will just have days and weeks in which it's running and taking all its names and moving all its names with it. Sometimes we'll have slow momentum, like when there is a Federal Reserve meeting, or where there's a president election. Anything like that may slow down the momentum of the market because capital is simply not moving it as much. Another thing that I look for when it comes to day trades and scalps is previous gap up and then a healthy consolidation. So if there's a stock in which gapped up recently and you see a lot of consolidation within it over the next few days or weeks or whatever it is, that's one candidate that you have to watch to eventually give you that day trade. And this also works for swing trades and position trades. We'll talk more about this when we talk about a technical analysis course, but this is not something we're going to cover too much in this course. Another thing that I want to talk about here in this slide is just because a stock is going up, it doesn't mean there's a healthy setup for entry. So many times I see traders fall into this trap in which they see a stock is moving up and they want to get in it. They want to move, they want to make money on the stock, but just like we stated earlier, if you don't have a blueprint and a clearly defined entry and stop loss and exit point, then you cannot take that trade because you are simply gambling at that point. So if a stock is already moving up, it doesn't mean that you can get in it. It means that you can watch it, and if it creates a healthy setup, then we can enter the stock. Creating a healthy setup and knowing when to enter all comes from time and experience and knowledge and education, in which I hope to deliver for you in the Hyper Chat and through the Hyper course. Another thing to cover on this slide is just because a stock opens high on the day, it doesn't mean it will continue rallying. So this, and I cannot stress this enough, is the most important thing that I say every single morning to every single person in the group is do not rush your trades. Everybody and anybody right out of the gates wants to get into stocks. We don't know what the stock market is going to do. You cannot measure the weather. You cannot predict the weather. You can only plan for it accordingly. And in the first few moments of the stock market, usually up to the first 30 minutes, the stock market is completely irrational. It does not have a direction. It simply is there for people who are in and out of stocks within seconds, or people getting trapped into stocks that looked like they were about to go up, but they actually went the other way. And a lot of times this happens when it comes to the news. So there will be a news article that seems like it's going to push the stock into sky highs, but next thing you know, the stock opens super high, People jump in and then it falls right through the ground and right through its supports and keeps on falling through the day, making people lose profits with it. So very important that you don't want to rush your trades in the morning. You want the stock to develop some kind of pattern for the day before you start beginning and form setups around it. Next thing or next strategy is swing trading. So what is defined as a swing trade? A swing trade is the purchase and sale of an equity, typically within but not limited to a 2 to 5 day range. Who are swing trades for? Swing trades are perfect for anybody and everybody, especially if you work a full-time job. If you work a full-time job and you can't watch the market all day, every day, swing trading is perfect for you because when it comes to swing trades, you enter the setup. All you need to know is set up conditional orders. And if you don't know what conditional orders are, go ahead and reach out to me. I have a video for you. And you want to check the chat. Not all the time, as long as you're checking the chat within, a morning and evening time or right before market closes, then I would already have updated our swing trades. You would see any updated stop losses. You would see any profit taking points. So swing trades are perfect for full-time employees and perfect for anybody else that's looking to make money. Stocks to focus on for swings, we want strong sector momentum. So when I say sector, I mean if the airline sector happens to be in focus right now, then this is perfect because now we have American Airlines, United Airlines, we have Southwest. So all those different stocks are seeing momentum, therefore we can safely enter a stock for a swing. Underlying catalyst. So another thing about catalysts, we want stocks that have some kind of catalyst that's moving them up. So if the TSA is reporting that flights have been going off crazier than ever and people are flying all the time, and we see that the stock is reacting well to it. It's not enough that the news came out. It's very important that the stock is actually reacting positively to the news. Then we can create a swing setup around that stock. Also, recent strong breakouts or earnings. So if a stock reported very strong earnings for the quarter, that means it's a perfect time in which we can watch the stock to develop a new consolidation form for us to enter a new setup. One thing to comment here about earnings is many people will try to play earnings. Simply at Hyperstocks, we don't ever play earnings unless we're in a position trade. Earnings are super, super risky. Not something that we play at Hyperstocks. Earnings will always give you an opportunity after the fact. So if you see a stock that reported earnings and they gapped up 30% the next day, that doesn't mean they're finished there. You want to let that day develop. If they close near the highs of the day, you can watch them over the next day, few days or weeks as they consolidate before they break out of that high again and they give us a setup at that point. Entering before the earnings are released is extremely dangerous because earnings are completely 50-50 and they can send the stock in either direction and they can keep it in that direction for a long period of time. So when it comes to your approach for swing trades, you want to do the following. You want to gauge overall market health for your initial position. So if say Amazon is moving up today, but overall market health seems to be weak, that doesn't mean it's safe to enter Amazon because it's the only stock moving up. Markets will always catch each other up. So if the entire market is moving down and there's a single stock that's moving up, there's more than likely a chance that that stock will turn around and catch up to the bottom of the market. So you want to be able to gauge overall market health when entering any position, not just the health of the specific stock. And this is for swing trades. Updating stop losses daily to a point just below a newly created support. So when I update our stop losses on a daily basis, I always place the stop losses under a new formed support to make our entries less risky and to make our exits less risky. So when I say update your stop loss to this point, it doesn't mean that I want us to get out of the stock sooner than expected. I just want us to be able to limit our down risk. The first day we enter a swing trade is going to be the riskiest because that's going to be the riskiest stop loss. But the moment that stock starts moving up and creating new supports, our stop loss is typically being updated as the stock is moving up to a point in which even if it was to turn back down, we'll still walk away profitable or we'll still walk away with a very, very small loss, if not break even. Having a price target before entry. So that goes along with the blueprint of the stock. If you get on a freeway, you know your exit. And if you get into a stock, you need to know your exit. A lot of times traders do not know when to exit a stock, which is why we provide price targets. Price targets are simply derived from resistance points. So as stocks move up, we look at their historical data and we look at any previous resistances that they have made, and if they are approaching that resistance, we make that our price target to take profits at before it tests it and fails to break it. Finally, approaching swing trades, it's very important that you look up company events or upcoming earnings prior to entry. So if you're about to enter a stock for a swing, you want to know everything you can about that stock. So if there's some kind of news article about them or some kind of negative article about them, you want to be aware of these things and you want to gauge how poorly or severely they can damage the company or even help the company for your setup. Position trading. Position trading is very similar to swing trading, except it's on a much longer timeline. So position trading is taken typically on stocks with not just stock chart health. So swing trades are primarily based on charts and technical analysis. When it comes to position trades, they're based on strong fundamentals. So if you look at our swing trades or our history of swing trades, you'll see that our swing trades are in companies like Microsoft, Apple, Square. So all these are strong fundamental companies. So they have numbers to back up their positions. So we can afford to hold them for weeks and months, even suffer losses on them for months before they come around to meet our price targets. So position trading is usually with stocks that have a strong underlying book of business. So these are companies that we trust. Who are position trades for? Position trades apply to the same people doing swing trades. So if you are a trader that don't want to check your phone every single minute for the stock market, you can take on position trades and just buy and hold. Simply takes patience. Simply takes those who have are typically in a larger portfolio. So if you have a larger portfolio, you can make a lot of money doing position trades because they're typically in larger cap companies that have higher costs. So we have covered the three different trading approaches that we have on the stock market in hyperstocks. So first, day trades, in which are suitable for anybody that's able to watch the market, minute by minute every single day. We have swing trades are perfect for full-time workers who can't have the stock market in front of them all the time. Same along with position trades. Position trades and swing trades apply to the same different types of traders. So what separates successful traders? First, position sizing. So a lot of times people wonder what the proper or correct position size for any stock is. The way I put it is use the 10% rule. If you have a $10,000 account, you shouldn't be risking more than 10% of your stock portfolio in a single trade. And that doesn't mean that you are willing to lose 10% of it. That just means you risk 10% with a stop loss on that 10%. So if you have a $10,000 account and you buy a stock and you buy $1,000 worth of that stock, your stop loss should still be effective at a 3 to 5% rate. So even if you were to lose on that $1,000, you're only losing 3 to 5% because you have created a stop loss point for your setup. Leads me to my next point, honoring your stop loss. I cannot stress this enough, you guys. Honoring your stop loss on the stock market will make or break your career, and it will make or break your bank account too. Don't get me wrong, guys. My approach to the market may be very, very modest and sometimes very low risk, that it frustrates some traders that we are exiting a stock even though it's only a few cents down. But the way to succeed on the market is by limiting losses. So many times I send out a setup and a few weeks later I get a question, hey, are we still in this because I have a position in it? And it's the stop loss is already 10% up and they're already losing so much money. There are tons of stop losses that I can provide on every setup. If you're not happy with the stop loss given and you need a higher risk stop loss, please ask, but just have one there to protect you against a downturn. There is a trade and then there's a gamble. And a trade has a stop loss point because it limits your risk to the downside. If you missed your stop loss, ask for a new one. As we mentioned earlier, stop losses are derived from created supports. As stocks move up and down, they form supports in which they bounce off of. Support points are typically buying points for many traders. And if that support is lost, traders exit the trade. And you don't want to be the trader that's stuck in the trade while everybody else is exiting because they honored their stop loss. Next, realistic goals and expectations. So don't come in with a $1 million mentality. I really hope everybody grows their portfolios to millions and millions of dollars, but you need to have realistic goals and expectations. One, for your own account and your own account size. Two, for the stock market as a whole. Sometimes we do have those 20 to 30% hitters. Sometimes we have over 100% hitters, which is completely, amazing, and that's what we shoot for and aim for. However, we need to have realistic goals to walk away with 5% gains, to be happy with the 6% gainers. So you need to have those realistic goals and expectations as you approach the market. Last but not least, adapting to different market conditions. So many times I see traders carrying last week's strategy into this week's strategy. In today's market, especially with the phenomena that we're seeing, every single person in the world seems like they're trading stocks now. You have to think about it this way. With all the volume that's coming into the stock market, there's going to be a lot of different types of movements. So you can't carry forward the idea that we had yesterday into today, because the market is an ever-evolving world that's completely going to change week over week, sometimes month over month, and we need to approach it with different mentalities as it approaches, as it evolves and changes. So adapting to different market conditions is kind of my job to do for you, but you need to understand when we are adapting to different market conditions. So if I send out an analysis stating that, hey, this is what I'm seeing in the overall sectors in the market or the overall indexes, then you need to read that thoroughly and apply those types of approaches to your own trading. We already covered blueprints, so every blueprint or every setup or every trade that I send has an entry point. If you missed your entry point and you need an updated entry, then let me know. If you missed it by too much, sometimes you simply have to accept the fact that you missed on the setup. Stop loss points, firm stop losses, guys. You have to honor those stop losses. Price targets, very important. You need to know your exit point before you enter the stock, so price targets are always set. You have to also be flexible with everything except your stop loss points, you guys. So if I set a price target for a stock at 22 and I send out an alert for you to take profits at 21.60, it's not because I want us to make less money. It's simply because I'm seeing weakness in the chart. Now, I got asked a question not too long ago saying, how do you know that a stock is, it's time to take profits? That is all done through technical analysis. That's all done through candlestick charts, in which I'm not going to cover in this course, but I will be covering it at a later time. So let's go ahead and pull up some trade updates, and I really want to pull this up for you so you can kind of see exactly what I mean by this. So if we look at the hyper alerts chat, let's go ahead and pull that up. So hyper alerts. Here we have a time in which I send out setup updates. So see, these setup updates you can expect one in the morning time and then one roughly an hour before market close. So when I say confirmed swing, or when I say stop loss updated to, all that I'm doing is, hey, we had an American Airlines set today or yesterday that I'm confirming for a swing trade. I'm just kind of reinforcing the fact that this is indeed a confirmed swing. Now, when I say high risk swing, that typically means you want to take on a less risk. So remember that 10% rule I told you, that, hey, if you have a $10,000 account, you only want to risk 10%. You want to do a 5% here. So high risk swings or high risk trades, you typically want to position less or risk less money in that trade until it starts moving in our direction or until further notice. So high risk swings, very important, or high risk trades in general, to risk less money when you're in them. And then let's move up a little bit to see if we can cover anything else here. So let's refer to a time in which I said take 50% or close 50% here. A lot of times traders may not know what I mean by that. I just simply mean, hey, close 50% of your position. So if we enter a stock at 10 and the price target's 15, and we close at 50% at $15, that already leaves us so profitable that if we updated our stop loss to $10, we're still going to walk away profitable. The idea of closing 25, 50% of the position is not to make less money, it's to simply guarantee money on the way up and to leave us less risk if the stock was to turn back around. So closing 50% just simply means close half your position, or close 25% of your position. It means close quarter of your position and leave the remainder open until further updates. So let's go ahead and refer back to our webinar. Let's see where we are. So we covered that. So tools of success for anybody on the stock market. If you are an active trader and you want to keep up with the news, I recommend you look at Yahoo Finance, CNBC, and First Squawk. First Squawk is a Twitter account you follow. I recommend you have their notifications on. They're going to tell you a lot of market updates and important market updates. Scanners to use. So I personally use FinViz, Market Chameleon, and Thinkorswim. So all those different types of scanners I use. I'm not going to get into too much of our scanner settings. I'm going to save that for another video. And then one disclaimer, the media is not always on your side. So sometimes CNBC will report that, hey, Boeing just had an outstanding contract delivery. That doesn't mean the stock is immediately going to go up and you need to go jump into it. Remember the blueprint idea. So even if you see a very strong headline, you want to make sure that you are creating a blueprint for the trade and not just jumping into the trade based on the news. So just because a stock is moving up on a news article doesn't mean it will continue that move up. Cutting losses and stop losses. So we already covered this. Where do stop losses come from? They come from support points. Every chart has dozens of supports to use. So if you want a higher risk stop loss, you can simply ask for one. The trader decides to take the risk percentage for every setup. So I have a very low risk tolerance because I'm a very modest trader. If you have a higher risk tolerance, then ask me for a higher risk stop loss. It doesn't hurt to do so. And sometimes I'll advise you to completely not use a higher risk stop loss because the setup is simply too high risk for one. A little bit about fundamental versus technical analysis. Fundamental analysis is derived from company earnings, their financials, their books, certain events that the company holds, forward guidance that the company has. So this is all more of numbers and long-term gains. So technical analysis is based on charts and using candlesticks typically to trade. Very important message here is stock market wisdom will always drive successful companies bullishly in the long run. So they will drive them up in the long run, but they will have a ton of ups and downs in the short run. Failing companies will always be driven down in the long run. So if a company is moving up, but traders and investors start to see that their fundamentals are not matching their price, slowly over time, that company will begin to slope down and lose that market cap and lose those buyers. So market wisdom will always control fundamental analysis. If a company is doing well numbers-wise, they will find traction to eventually move up bullishly. But if they are doing poorly and they have been in a bullish run, then they will find their way back down eventually. Everything we do on those ups and downs in the long run is called technical analysis for taking advantage of the short-term movement on those charts. So we're using charts to capitalize on the short-term ups and downs, but the long-term picture will always be driven by the numbers of a company and not the chart of a company. Scanners, we already talked about this. So primary scanner we use for swing trades is going to be on FinViz. When you joined the group, I sent you a link in which included the FinViz scanner that we use all the time. So you have access to that, and I'll be remaking that video for an updated version shortly in the future. Trading discipline. Most important part of trading is your own discipline. So nobody is ever going to sit there and tell you to cut your position at a specific loss. I can tell you that all the time, but it's up to you to have the discipline to do so. Never try to catch the top and the bottom of every stock. Everybody wants to capitalize on all the movement and the up and the top of a stock, but focus on the 80% in the middle. It's very rare that you ever catch the very top or the very bottom. Cut losses without asking what if. So last time, some traders will say, well, last time I cut losses here, the stock shot back up. Well, that doesn't always happen. Sometimes the stock will lose that support and never come back around. So you have to cut losses like a robot. Trade like a robot and don't look back. Don't think about your previous setups or what happened last time. You have to think towards the future. You can't think about, hey, well, last time I exited the stock and it shot up another 20%. That's not applicable. Lightning does not strike twice in the same location on the stock market. You want to be able to trade with that same blueprint every single time. If the stop loss hits, the stop loss hits. If price target is achieved, take those profits. So don't bring in your previous setup's successes or failures into a new setup. Before every setup, you want to restart your mind, you want to reset your strategy, you want to reset yourself for a brand new stock, for a brand new entry, for a brand new exit. You don't want to say, hey, I hit 50% profits on the last setup. I'm going to shoot for that same 50% on this trade because this trade may not have the same abilities and capabilities of that last trade. Finally, last but not least, questions during market hours. You guys, I can't stress this enough. I encourage all questions during the stock market. If you need help, just ask. Everybody is more than welcome to ask me questions. I will be doing my best every single day to make sure we're all profitable, we're all moving in the right direction, we're all learning and we're all growing. All I ask of you is to direct your questions to the main group. That's because everybody learns from the questions you have, and it helps to create teaching opportunities for everybody in the community. If you need a timely response, a more thorough response, ask a more detailed question. So if you ask thoughts on Hulu, I'm sorry, thoughts on Netflix, or anything like that, then I'm simply gonna give you my thoughts, but I don't know what strategy you're going for. So if you say, hey, I'm in this stock, I'm in it for the long term, I have it at this average, what do you think? Then I'll be more than happy to give you a detailed answer. A detailed question leads to a detailed answer. A vague question sometimes can lead to an unwanted answer or an answer that you did not want or did not expect. So that's pretty much how I'm going to close this webinar. I really hope this was helpful. I really hope everybody took something home from this. I know a lot of this is basic information, but I just wanted to relay it. I wanted to clearly paint a picture of how our approach is for the stock market, why we do the things we do, the different types of approaches that you can take on for your own personal gain. Thank you guys for checking in. You guys have a great day.